Welcome everyone to today's webinar. I'm Josh Brockwell. We'll get started in just a moment. A reminder at the outset, though, that today's webinar is being recorded. Give us just a moment or two for folks to trickle in, and we will be off and running. All right, with that, let's get started. Thanks everyone for being here. Welcome again to today's presentation on the state of Azzad Asset Management. We're using the opportunity today to give our clients and friends the chance to see how we're doing as a firm, in addition to offering updates on the markets and our work overall. I'm Josh Brockwell, Investment Communications Director here at Azzad, and I'll be your host for today. So we'll look today at 4 key issue areas. They should be on your screen now. First up, company updates, Azzad updates last year up through today. Next, what drove market performance in 2024? After that, where are we now? And then we'll talk about some next steps. For those of you who may need a refresher, here's a look at who we are. The company was founded back in 1997, headquartered outside Washington, D.C. in Falls Church, Virginia. Currently, or as of 12/31/2024, $1.6 billion in assets under management. And we specialize in halal financial planning for high net worth individuals across the United States. And as a reminder, we are a full service financial planning advisory firm. Here's an overview of the services we provide on your screen now. From investment planning to tax and charitable planning to halal financial services across the board, we have positioned ourselves as the leading provider of halal financial services in the United States. So a quick look at our accomplishments. 2024 was another year of awards and recognition for our firm, which also celebrated 27 years in business. The year marked our 4th time being named to the CNBC Financial Advisor 100 list. And it was also another year of being named to the Financial Advisor magazine RIA ranking. The awards keep piling up. We don't do it for the recognition, of course, but it's nice when people notice your hard work for clients. Also, reminder, please visit azzadasset.com, our website, for more information on the criteria for obtaining these awards. Moving on, a quick update on one of our value-added services, shareholder advocacy. Azzad engages in shareholder advocacy on behalf of our clients, including proxy voting, filing resolutions, and engaging with corporate management. Some of our recent advocacy efforts are shown on your screen right now. We're particularly proud of our work with Chevron over the last several years on Myanmar and the horrific ethnic cleansing of the Rohingya Muslim minority in that country. Chevron was once the largest U.S. company operating in Myanmar, where crimes against humanity had been taking place at the hands of the military. Thanks to efforts by Azzad and a large coalition of shareholders, in fact, many faith-based, Chevron announced in recent years that they were leaving the country. In addition, we also secured a sizable contribution, a financial cash contribution for the Rohingya refugees in Bangladesh. This year, we're continuing to work with our partners in the faith-based community and the socially responsible investor community to take action against tech companies that shut down accounts or downrank content on Palestinian issues, very focused on that in 2025. Moving right along to stock market performance in 2024, the year was another year of American exceptionalism, if you will, as far as stocks and the economy were concerned. Last year was the 2nd consecutive year with S&P 500 gains of more than 20%, as shown on your screen right now. That's the first time that's occurred since the late 1990s. And yes, American stocks closed out another impressive year on Wall Street, but their performance relative to the rest of the world was even more remarkable. The U.S. large cap benchmark, S&P 500 index, which we'll talk about more in just a moment, surged 23.3% in 2024, outpacing the Stocks Europe 600's nearly 6% advance by the widest margin in 4 years. Japan's Nikkei index was up 19.2, and China's Shanghai Composite rose 12.7% in the same period, according to FactSet data. So let's take a closer look at the index that we just showed you on the previous slide, the S&P 500. So that S&P 500 or Standard & Poor's 500 index is a collection of 500 leading publicly traded companies in the US. I should mention that it's not an exact list of the top 500 US companies by size because the index includes other criteria. The S&P 500 index is nonetheless one of the most relied upon gauges and one of the most cited gauges in the American equities performance and the stock market overall. But it's not the stock market, it's important to remember, and there's a lot more that folks should be invested in to better manage risk and meet their financial goals. Investing solely in the S&P 500 limits your exposure to a single market, in this case it's the United States, and a specific set of companies. It's those large companies that I just mentioned to you. This can increase your risk. Here's why diversifying beyond the S&P 500 is crucial. First of all, geographic diversification. The US economy doesn't always move in sync with the global one. International investments can cushion your portfolio during market downturns in the United States. There's also sector diversification. The S&P 500, while broad, may have concentrated exposure to certain sectors. That's what we're going to talk about in just a minute when we get to the Magnificent Seven. Diversifying across different sectors like technology, but also healthcare, energy, etc., reduces your vulnerability to sector-specific shocks to the system. Also, company size diversification. I mentioned that the S&P 500 was predominantly large cap US stocks, the big companies out there, including small and mid cap companies, often found outside the S&P 500, can enhance long-term growth potential. So all of this is with an eye toward reducing volatility. Diversification is a way to do that. It helps smooth out those ups and downs in the portfolio. Of course, it doesn't guarantee against a loss or anything of that sort, but it is an important part of investing. When one part of your portfolio declines, another may be performing well, which mitigates overall losses. Let's drill down a little bit on this with the following slide. So on your screen now is a graphic that shows why it can pay to diversify outside of a single index like the S&P. I've put on your screen now Azzad's halal investment strategies ranked according to performance year by year. So what are these? This is small, mid, and large cap growth and value, international, dividends, and real estate, kind of across the board. The dispersion of returns across each asset class from one year to the next is unpredictable, as you can see on the screen. And it's often better for your risk tolerance and your return expectations if you spread out your money, because no one knows from one year to the next how a particular index or investment will perform. On one level, a diversified portfolio should be diversified between asset classes, such as stocks and fixed income. But on another, a diversified portfolio should also be diversified within the asset class, such as a diverse basket of stocks. Ancient Chinese merchants, I like this metaphor or story that's been said before. Ancient Chinese merchants were said to have developed a unique way to manage their risk. They would divide their shipments among several different vessels. That way, if one ship were to sink or to be attacked by pirates, the rest stood a decent chance of getting through. So the majority of the shipment could be saved. Your investment portfolio may benefit from the same logic. So let's talk about single security risk. Diversification is an investment principle designed to manage risk. However, as I mentioned before, it doesn't guarantee against a loss. The key to diversification is to identify investments that may perform differently under various market conditions. The S&P 500 overall has measured standard deviation, which is a measure of risk or volatility, historically around 16%. Yet the standard deviation or the volatility of the average stock in the index measures around 46%. Huge difference. Many investors are unaware of this. Additional volatility can have adverse consequences financially and emotionally. That's not to be underestimated. And it can affect retirement distributions and the amount retirees can safely draw down in retirement. As we wrap up this section, let's not forget the lost decade for stocks. That was 2000 to 2010. That's when the S&P 500 finished the 10-year period from 2000 to 2010 with a negative return. Yet it was a good decade for investors who diversified their holdings globally beyond US large cap stocks like the S&P 500 and included other parts of the market with higher expected returns. Companies with small market capitalizations or low relative price, so-called value stocks. A range of indices across many other parts of the global market outperformed the S&P 500 during that time span. Now, I should also mention that the next 10 years were remarkably successful for the S&P 500. And the point is that no one knows what the next 10 months will bring, much less the next 10 years. But maintaining patience and discipline through the bad times and the good puts investors in position to increase that likelihood of long-term success. But I will also note that there has never been a negative 10-year return for a diversified mix of US stocks and fixed income. That's food for thought. So a couple takeaways from the previous slides. Diversification is a fundamental principle of investing. The S&P 500 probably isn't the only thing you should be investing in. Investing solely in the S&P can expose you to significant risks, and diversifying across geographies, sectors, and company sizes can help reduce risk and potentially enhance returns over the long term. Now let's take a look at what drove market performance in 2024. 2024 markets were primarily concerned with how the Federal Reserve balanced inflation concerns with overall economic resilience. Many anticipated rate cuts early in the year, though the first rate cut did not materialize until mid-September. While inflation concerns and geopolitical tension persisted as economic headwinds throughout 2024, powerful tailwinds propelled markets to record highs. Advancements in artificial intelligence, the big issue, AI technologies, played a major role, as evidenced by the stellar performance of tech-heavy indices like the NASDAQ Composite Index. Other notable tailwinds included persistently low unemployment rates and steady consumer spending. Following the November presidential election, markets rallied to record highs. Keep in mind that historically, presidential elections have proved to be poor predictors of market performance for the 12-year period following an administrative change. However, past performance is no guarantee of future results. It was the fourth year in a row with the S&P 500, there's that index again, outperforming the Russell 2000, with 2 of those years showing a spread of more than 10 percentage points, as shown on your screen now. And that outperformance was due in large part to the Magnificent Seven group of stocks, up nearly 67%, along with a handful of other mega cap stocks. So there's an old adage on Wall Street about market breadth that it goes something like this. The market is strongest when the soldiers and not just the generals are at the front line. And it's on this note that one can quibble with how strong performance has been below the surface of the big indexes. By the end of last year, the 10 largest stocks within the S&P 500 had grown to a 39% weight within the index, the second record high by far set in 2024. As shown on your screen, for the full year 2024, only 19% of stocks within the S&P 500 outperformed the index itself. So that market breadth remains an issue. So where are we now? Let's take a look at where we are now and examine the headwinds and tailwinds that could affect the direction of economic growth and financial markets in 2025. So it's clear that the 2025 economy may face some broad challenges. The first headwind facing the markets is inflation and rising bond yields. Both of those can hurt businesses. Inflation can make consumers less likely to spend on certain items, while higher bond yields increase business investment costs, thereby reducing profits. So inflation remains above the Fed's target of 2%. But the good news is that inflation has come down a lot over the past few years, and the Fed has begun a rate cut cycle, which is historically good for stocks. It is in no hurry to cut rates further, however, as noted at the most recent Fed meeting, so TBD on how markets react to that. It will also be important to see how Congress handles the upcoming debt ceiling limit in mid-March, as this is historically a time for volatility. If Democrats decide to use the occasion to extract policy concessions, as Republicans have done in previous years, there may be some brinkmanship, but it could also mark the end of this vicious cycle if both sides finally agree to eliminate the debt ceiling entirely. So TBD on that one as well. Lastly, though, geopolitical tensions are a potential headwind as well. Headline examples include the ongoing conflict between Ukraine and Russia, China's threats toward Taiwan, and any trade wars triggered by the Trump administration. But it's worth remembering that it's often the geopolitical event that no one anticipated that surprises markets. Another quick point about interest rates before we move on, those weigh very heavily on markets. Treasury yields continue to surge as strong economic growth, stalled inflation, and uncertainty about fiscal policy in the long run have shifted expectations about how much more easing the Federal Reserve is likely to do. Remember that yields move inversely to prices. Over the past 6 months, the market has gone from pricing in 4 to 5 rate cuts, or 100 to 125 basis points in the federal funds rate this year, to pricing in just one. It's a big difference from just a few months ago. So while we understand headwinds facing stocks are not to be underestimated, there are several potential tailwinds that may support financial markets in 2025. To be sure, tech companies and the rising demand for artificial intelligence continue to be a driving force behind the US stock rally in 2024. The combined market capitalization of the so-called Magnificent Seven group of tech behemoths reached $16.7 trillion as of December 31, surpassing the European market's $16.1 trillion total market cap. That's according to Dow Jones market data. AI darling NVIDIA emerged as the largest gainer in terms of market capitalization in 2024. The company added nearly $2.1 trillion in market value in 2024, closing out the year at around $3.29 trillion, according, again, to Dow Jones market data. Now, that it has come down as of late, considering some advancements in Chinese AI. But such leadership is expected to help the U.S. market stay in the lead in 2025. However, investors should look for some convergence of U.S. stocks versus the rest of the world equities, if you will, and that the outperformance is likely to normalize from here. And as I mentioned, we've already started to see that with recent news about cheaper, more efficient Chinese AI alternatives coming onto the market. Significant risks are indeed coming from the policy side, with much uncertainty on how Trumponomics will materialize and whether that Fed will manage to keep the Treasury yield below 5%, as I mentioned, which is where they seem to have settled lately. That's where yields are, roughly. Tech stocks will be vulnerable in 2025 due to potential retaliation from the Chinese government against the U.S. crackdown on chips, as well as how soaring AI demand might be overhyped. And it remains to be seen if and when Congress finalizes an extension of those Trump tax cuts from 2017, and if the new presidential administration follows through on its promise of fewer regulations. So regardless of headwinds and tailwinds, both of which we've just looked at, there are a few things that we do know for sure. Retail investors lagged the S&P 500 on a consistent basis, and they did it once again last year. There's the saying by the author of The Little Prince, "A goal without a plan is just a wish." In financial services, we like to say investing without a strategy is just a dream. At its core, an investing strategy is designed to help you, number one, track progress toward your goal. Number two, define your risk tolerance. Number three, set out your time horizon. And perhaps most importantly, number four, help define and measure your success. The chart on screen shows our fears about what happens when people invest without a clear, well-defined strategy. In 2024, individual investors again lagged the S&P 500. We all know why. Fear, greed, and overconfidence can cloud judgment and lead to poor decision-making and bad returns. So, what can you do in 2025 to move closer to your goals? Here are some action items for you. If you're currently in a concentrated portfolio, perhaps of a few tech stocks, or concentrated in a sector like the tech sector, and are confused about what to do next, reach out to us. We can help you develop a strategy that works best for you. If your life or personal situation changes, keep us in the loop. We want to hear about important family events like births and deaths. We also care about health issues, employment changes, and any financial developments that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us. so we can help you pursue the life that you most desire. On top of specific adjustments in your financial life, we also want to know how you feel about your investment changes. How do you feel about them in general? These could be details like a risk tolerance shift or any market environment concerns. Let us know. Finally, remember to review your estate documents, beneficiary designations, and other paperwork to ensure that they're all up to date. A well organized estate is one of the best gifts that you can give to your family. We're here to discuss any financial questions or worries that you might have. Our priority is always to help you make informed choices and to stay on track. So, real quick, what else can investors know? Remember the power of compound returns. That's the cumulative effect of gains or losses over time. That means that even small differences in portfolio returns can have a substantial impact over time. Establish realistic financial goals, develop a financial plan tailored to your personal goals, and be ready to adapt as life circumstances change. Azzad Asset Management's advisors can help you create one of those plans with more realistic expectations. Also, maintain savings discipline. While returns can fluctuate from year to year, resist the urge to reduce your saving in response to market volatility. Expected returns are not guaranteed, and the more you save, the greater cushion you'll have if actual returns fall short of your expectations. And build a diversified portfolio. Construct a portfolio aligned with your risk tolerance. Do this in consult with your Azzad advisor, using a mix of asset classes that perform differently under various market conditions, as we've already talked about. Since predicting the best performing asset class each year is an impossibility, diversification helps to mitigate the impact of market volatility and reduces the risks of chasing past performance. Throughout 2025, we'll focus on delivering the following things. We'll keep you informed through regular communication. We'll manage your investment strategies according to your personalized plan. And last but not least, the Azzad Investment Committee will continue to do its due diligence on our portfolio managers, including those quarterly conference calls. Thank you all for your time today. As you can tell, we at Azzad are passionate about helping you understand the markets. We want to keep you in the know. For more information and timely updates, please follow us on social media and visit us at azzadasset.com. We hope that you've enjoyed today's presentation. I know I've enjoyed giving it. Thanks again for your time.